Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby P. Kinzer. And I guess that's kind of delayed over there today. So welcome everybody. It's such a joy to have you join us another day for the FITT Show, where we can provide information that can enrich your understanding of investing and savings and budgeting and credit, all those things pertaining to building wealth. This has been this is 113th show, though. We've really been rolling on. Just want to thank everybody for tuning in as always, and we ask you to make sure you click on the like button. That always helps us get access to more individuals out there, and put comments in the comment box, because that also gives us actually it gives us compounding access to people, because the comment box has more power. So, and if you have, we have some opinions on what we talked about, or if you have some other topics you'd like for us to discuss, we will take and discuss those topics. No problem. As always, we just want to make sure, give our disclaimer that we are not financial advisors. We are financial educators. We're going to give you information that is very applicative to your life, but we're not really we're not selling products. So we will not recommend particular products, because we're not in the business to make money. We're in the business to educate. So please keep that in mind. And with that, Dope, how are you doing today?
And I'm happy as can be, chasing my grandkids around, and I'm worn out. That's young people. That's young people work.
Oh boy, I'm finding that out, though. These past few months, I've been actually feeling my age, and that's a good thing. It beats the alternative. I know that much. So, Dope, as we always start at the top of the show with the I guess a lot of people always asking me about the stock market and stocks, and that's why we start off with the stock market update.
Yeah, and it's been choppy. There's been a lot of up and down in the market. The NASDAQ has been hit pretty hard lately, and there's a bunch of reasons why, and we'll talk about a few of those. But you can see the Dow has been pretty much flat the last week. It's only down about 39 points, where NASDAQ is down almost 2%. And some of the stocks that are heavily involved in, a big part of the NASDAQ, Microsoft, Tesla, they're all down. Tesla's down. It's interesting. They had been cutting prices for the last year or so to increase their volume, and they had been seeing great volume increases, particularly in China. But what happened in July, their sales volume actually decreased. And so it looks like they've gotten all they can get out of their price increases, or price cuts, I'm sorry. And one of their big competitors there, a company called, I think it's BVD, they actually grew their volume. So they're wondering if they've pretty much gotten all they can get out of their sales increases. So that's kind of why their stock has kind of took a little hit as of late. And Apple took a pretty big hit. They announced earnings on August the 3rd, and their earnings actually showed a negative revenue growth, or year to year revenue was down, mostly because of currency translation. But even if you take out currency, their real growth was only 1%. And so I think there's some concern about Apple as to whether or not it can continue its growth. And it's kind of funny when you look at it, because I think I have an iPhone 12 and they're about to come out with a 15. And I just can't imagine what they can bring out that could make me want to go buy a new phone. And so there's one group of people who are thinking that maybe Apple has reached this peak as far as the iPhone. People are keeping them longer, but one, because they cost so much. And so, I mean, it's over $1,000 to get the newest model with all the creature features. And so they're wondering if people are going to start switching to some of the mid-tier priced items as opposed to buying the newest and greatest iPhone, because it's part. I just can't see what else they can put into an iPhone. Now they are getting some pretty good growth in some of their services, and in the Apple TV Plus, the Apple Fitness. They're getting some growth there, but it's not making up for the fact that the iPhone isn't growing like it once did, and also the Mac growth has stagnated now that people are going back to work, and so they aren't seeing the big increases there. So we got to keep an eye on Apple. That's a pretty nice little drop. Pfizer's up $1, but it hasn't really done that much. And Nvidia has also taken a big hit. And that was due mainly to a company that they supply reported earnings and made the comment that they're expecting a revenue decrease. And so that had a ripple effect on Nvidia and had its price go down. Now, Nvidia's price had been steadily moving. I mean, it's still up. I mean, we're showing it down for the week, but it's still up 192% for the year. So that's just crazy. That's some crazy growth. So you kind of expect some, I don't know if it's profit taking or some people just taking a breather, but it's still showing tremendous growth. And we'll have to see what it does in the future. And Google's kind of hung in there and still doing pretty good. Still going pretty good. So all in all, it's going to continue to be choppy until things get settled down with inflation. The number is still higher than the Fed wants it, but I think the jury is still out on whether or not they're going to increase the interest rates again when they meet, I believe, in September. So just hang tight, as we always say.
Yeah, the Nasdaq took a big hit there out of all. 'Cause other than that, the other ones didn't seem that major. But Nasdaq, that's well, Apple too, that's pretty big. But
Just remember,
Nasdaq,
it's grown this year. That's the other thing to keep in mind. When you look at what it's grown, this NASDAQ, I think it grew the first 6 months. You have to go back like 20 something years to find that much growth in the first half of the year. So there's always going to be,
if I'm right too, it was something like 37%.
yeah, it's crazy. It was crazy up. So it's kind of to be expected, you know, it's kind of to be
Well,
expected.
well, that's what they're talking about. The market analysts are talking today about this is how the market does. It starts correcting itself and
Hmm.
cooling off, and it readjusts itself. And because they're saying the growth in the last, because it was growing in the last, I think it was a 5 week consecutive growth in the market, and that was unusual too. So they said it tends to reorder itself, because people get out into buying and selling all of a sudden. But like we say, it's always about the long play, dope. You
That's for
know,
sure. That's for
stay
sure.
steady, stay steady. You know, consistently, buy because dollar cost averaging definitely works to your advantage. And the market always seems like it comes back and provides you that growth that you need. Let's talk about the cryptocurrency market. It's been kind of holding steady. It haven't been too wild, but the market cap is just up 10 billion, but Bitcoin is up $260 since last week, $268 since last week, and that's pretty interesting. That if you had Bitcoin, and if you got in when it was down like 18 to 20, that $268 it could make a difference to what you have. That's per Bitcoin. Ethereum is just tagging right along, not doing anything. Tether, the Tether, the particular tied to the the dollar, like that's just been holding. And actually, the Dogecoin went down 0.001. And though I don't know what's going on with Shiba Inu, but ever since I said, okay, dope, we're going to think about taking it off, that you telling me, it's gone up another. It's only 0.0000001, but it was at 0.050 and point 0.6. And so that little incremental increase, believe it or not, can be, increase on depending on what you have. I don't know what's going on, but ever since you mentioned it to me, though, about taking it off, seemed like they got mad and it started going up. So that's it for the cryptocurrency market. Still steady. Once again, long-term play with that. And we know it's speculative anyway. So we hope the money that you have in that is money that you don't really need. Well, that's a weird statement. Everybody needs money, but it's money that you are willing to lose. Let me put it like that. Hey,
Yeah,
Dope.
you're taking a big risk to reap a big reward. That's basically what you're doing.
Yeah, that's all. So with that, Dope, before we get into the show, I want to share with the people this particular graph. It said all the right moves. 9 out of 10 Americans say they are taking at least one step to prepare for the possible recession. Now, if you listen to the analysts right now, they're saying right now, it's holding off, but recession is still looming, and it could happen at any time. But it's just interesting when you look at this chart, look and see where you all are. Now, 62%, almost 2/3 of the people say they really cutting back on spending. And then the next 40%, they say they're sticking to a budget. Me and Dope always talk about having a budget, always planning, always having a budget. Look at your budget, adjust your budget. The second largest move that people are looking at is sticking to a budget. The third, and this kind of confirms what we talk about. We always talked about building an emergency fund. 26% of people are, they're preparing for this recession, if there is one, by building their emergency fund. They probably had low funds and they building it up. Then the next one is, and it's interesting though, only a quarter of the people say that paying down the debt is which is more important to them right now. Because to me, debt is the biggest albatross around individuals' neck. But it shocked me that it was around about in fourth place. The next one was 24% were working a side job. We always talk about that added income stream. Then 6% were just adjusting their investments. And I guess that might be good though, because maybe people are holding, you know what I mean? Like we're talking about the long play. And then
Yeah.
6% is just improving their job performance. And that's so look at this chart, you all, and see where you fall in this chart. It's pretty interesting to know. Put some comments out there in the comment box and share with us to let us know. So with that, this week's show we're talking about another investment option. A lot of people are always asking us about, well, y'all talk about investing, talk about the stock market. So what should we do? So we're going to talk about index funds, and is our index funds right for you?
Yeah, and it's funny because if you want to invest money in the stock market. There's a bunch of different ways you can do it. And we've talked about you can buy individual stocks, and if you do, you really have to do a lot of research. And it helps if you know something about the company or you have a feeling that they're going to do well. And that's kind of when it pays to have some sort of financial background, because you can look at some of their financials and make decisions about what you think they're going to do in the future. Or you may read about an innovation they have or a new product they have coming out. But either way, it takes a lot of research to do that. And you got to know a little bit about reading and analyzing financial statements. If you don't have the time, or you just don't want to invest in individual stocks, you can look at different types of funds. You can look at index funds, which we're going to talk about tonight. You can look at mutual funds, or which are actively managed by the different companies. And that's when you give money to, let's say, basically an advisor, and he decides where to invest your money in different companies, which gives you some level of diversification, but you don't have much say over what he buys. And so the goal of an actively managed fund, you hope they beat the market. And when we talk about beating the market, we're usually talking about the S&P 500 index. That's the 500 stocks. And when we say beat the market, you want to do better than that index has done. Okay. And before we go on, I want to make sure you understand this point. Let's just say you want to invest in the S&P index fund. That means you are taking on the full risk of the market. So let's keep that in mind, and I'll come back to that a little bit later. So when we talk about the S&P fund, that represents the market. And so the one problem, we've mentioned this before, and I hope you understand this. The majority of fund managers don't beat the market, okay? And for whatever reason. And that's been proven consistently over the years. Very few fund managers actually beat the market. So when people go to financial advisors, they're typically not doing better than the market. And so the first index fund that was available to ordinary investors was the first index investment trust, which was launched in 1975, and it's still around. And now it's called the Vanguard 500 Index Fund. It was launched by Jack Boyle, who's one of the greats of investing. He was the late founder of Vanguard, and they call him the father of index investing. And at the time, critics warned that it would be unpopular, as they expected average performance, and it wouldn't entice investors. But that was obviously proving wrong. And this fund manager, they basically just mimic the index. They create a fund that looks as much as possible like the index that they're trying to mirror. In this case, it's the S&P 500, but you could have an index fund that mirrors the technical sector or the healthcare industry or the transportation industry or the automotive industry. There are endless options as far as which one you choose. And so over time, the index changes as companies get added, removed, and the index fund manager mechanically makes changes to replicate the changes in that fund. But we're going to get into a little more detail about exactly what an index fund is and does.
I lost that last statement, Dave, though.
No, I just said
It didn't come through. It didn't come through. Yeah, because you're breaking up. So we might have a bad connection because those last few words didn't come through. So can you hear me, though?
I can hear you fine.
Okay, cool, great. So I just want to reiterate that the index funds seek to match the risk and return of the market based on the theory that in the long term, the market will outperform any single investment. Now, indexing, index funds, is a form of what they call passive fund management. Instead of a portfolio manager actively stock picking and market timing, that is, choosing securities to invest in and strategizing when to buy and when to sell. That's an actively managed fund, and they usually charge more. The fund manager builds a portfolio whose holdings mirror the securities of the particular index. So indexing funds are passively managed because all it does is mimic and automatically adjust to the market, whatever index that it is pegged to. So the idea that is by mimicking the profile of the index, the stock as a whole or a broad segment of it, the fund will match its performance as well. That's why it's passive. But given an actively managed fund, it usually struggles to beat the market, like those say, and it is more expensive. Now, it's easy to see why funds and passive investing have, why index funds and passive investing has taken off in a big way, especially in the last decade or so. So, Doe, won't
Okay,
you start off by telling people what index funds are?
let's make sure we understand what it is. It's an investment fund. It could be a mutual fund. It could be an exchange traded fund, which is called an ETF. And it's based on a preset basket of stocks or index. Okay, this index may be created by the fund manager itself or by another company, such as an investment banker or a brokerage firm. Okay, these fund managers then mimic the index, be it the S&P, transportation, it could be overseas, creating a fund that looks as much as possible like the index without actively managing the fund. Over time, the index changes because companies may be added or subtracted or removed, and the index fund manager just replicates those changes in the fund. So there's not a lot of thought going into buying and selling because all you're trying to do is mimic a particular body of stocks, be it the S&P 500, transportation, automotive, but it's just mimicking that basket of stocks.
So, why are index funds, so popular, especially as an investment? Now, index funds are popular with investors because they promise ownership of a variety of stocks and it's greater diversification and low risk, usually all at a low cost. That is so important, which distinguishes from regular mutual funds and definitely individual stocks, right? But that's why many investors, especially beginners, find index funds to be more superior investments than individual stocks.
And the other thing they do they've given attractive returns over the years, like all major stocks, major indexes. You're going to have some fluctuation, so nothing's going to go up all the time. That'd be nice if it did, but that's not how it works. But over time, they've made solid returns, and we've talked several times about how the S&P long-term index has recorded about 10% annually. Now, that's not 10% every year. There's going to be ups and downs. There's going to be recessions. There's going to be bear markets. But over the long haul, they've averaged about 10% annually.
So let me put that in. So that something's happening with your mic though, because it cut off those last words again. I don't know if you can.
Yeah, nothing. I'm not doing anything different.
No, it's just the system. It's not you. It's definitely not you. It's just the yeah, because Garnett says you're breaking up. Okay, yeah. So it's not just me. Yes, your system. But we are slaves to technologies. So though I just want to talk about, and I mentioned it, but can't express it enough how index funds diversification about index funds. And investors like it because they offer immediate diversification with, with one purchase, you can own a wide variety of companies. Just one share in the index fund based on the S&P 500 provides ownerships of hundreds of companies. And that's why it's kind of, the risk is a little bit less, because while a share of the NASDAQ 100 fund offers exposure to about 100 companies. So you can even buy a whole industry, such as an energy ETF, exchange traded funds. So that's the key. You owning just a wide swath of of of, um, of companies, and the more diversified, they peg it to that, and how those companies go. The more you have, the more some are up or some are down, and that's how that works.
And you get lower risk because of that. Because you diversify, when you invest in an index fund, it's much lower risk than owning a few individual stocks. And this doesn't mean that you can't lose money. Again, let me make sure we're clear on that, or that they're as safe as a CD, because they're not. But the index will usually fluctuate a lot less than an individual stock. So your range of returns will be in a much narrower range than it would be in an individual stock.
And index funds charge very little for those benefits, with a low cost, meaning a low expense ratio. And if you're looking at any index fund, mutual fund, you should always look at the expense ratio, because the expense ratio tells you how much they charge you to manage your fund. And the larger expense ratio, the more they take money out that could be working for you. That's why you want a low expense ratio. Now, for larger funds, index funds, they pay anywhere $3 to $10 per year for every $10,000 of your investment. That's pretty low. They usually say that you can, and we're going to talk about expense ratios a little bit later, but it's a low cost, and some funds charge no expense ratio at all. And just remember, the less they charge you in expense ratio, the more that goes towards the compounding of your investment. When it comes to index funds, cost is one of the most important factors in your total return. Now, while some funds like the Standard & Poor's 500 that Dope talked about, or the NASDAQ 100 index funds allow you to own companies across industries, other funds only allow you to invest in a specific industry or country, or even like an investing style, saying like dividend stocks. But in index funds, you can go across different industries and funds, and this gives you a good variety.
Let's talk about how do you do it. Let's say you want to invest in an index fund. 3 easy steps to do it. First thing to do is find out what you want to invest in. While an S&P index fund is the most popular, there's a whole lot of different ones you can choose from. You can pick a country. You can pick regions of the world. For example, Europe went through the same, let's call it bad economic times that we went through, but it looks like they're recovering a little faster than us. So you might want to get an index fund that represents the European companies, or you can certain investment styles. So you got to consider exactly what you want to invest in and why it might hold an opportunity for you. Next, you look at location. Consider the location of the investment. A broad index such as the S&P 500 or the NASDAQ 100 owns American stocks, while other index funds might focus on a narrower location, France, or it might be Asia Pacific.
The next step is you can look at the market sector in which the index fund is investing in, meaning what type of business. You can invest in big pharmaceutical companies that's making new drugs, or you may want to invest in index funds that have tech companies in it. And some funds specialize in certain industries, and others avoid it. So there's a mix of the type of businesses that you can invest in.
Yeah, but you got to look at what the market opportunity is. What opportunities does the index fund present for you? Is the fund buying pharma companies because they're making the next blockbuster drug or because they're cash cows paying dividends? Some funds invest in high yield stocks while others want high growth stocks, which doesn't pay high dividends. So you got to carefully examine what the fund is investing in so you have some idea of what you own. You got to be cognizant of what you're buying. Sometimes the label on an index fund can be misleading, but you can check the index fund holdings to see exactly what's in the fund.
So you also need to start decide which index fund to buy. After you found out a fund you like we said, a particular industry or particular business or particular location, you can look at other factors that may make it a good fit for your portfolio. Now, the fund's expenses are a huge factor. I mentioned that. They could make or cost you tens of thousands of dollars over time. So pay attention to the expenses. Compare the expenses of each fund you're considering. Sometimes a fund based on a similar index can charge 20 times as much as another index fund.
You got to look at your tax situation too. For certain legal reasons, mutual funds tend to be less tax efficient than EFTs. So if you've owned a mutual fund, each year, usually around the end of the year, you get this giant capital gains distribution, and that's the result of all the transactions made throughout the year. So, but with EFTs, it doesn't happen that way. EFTs, it's all processes processed like a stock. All the transactions wash out. You don't get that giant capital gain distribution at the end of the year. So take that into consideration when you decide whether you want to buy an index fund or a mutual fund.
Another thing is many mutual funds have a minimum investment amount for your first purchase. Often several $1,000, sometimes $2,000, $2,500 as the minimum. Which, in contrast, EFTs, the exchange traded funds, they have no such rule, and your broker may even allow you to buy fractional shares with just a few dollars.
And so next thing, buying an index fund should be real easy. After you figure out which one to buy, you buy it. You can either buy it directly from the mutual fund company. That could be Vanguard, Fidelity, E-Trade, Schwab, or you could buy it through a broker. But it's usually easier to buy a mutual fund through a broker. And if you're buying an EFT, you need to also go through your broker.
Let's talk a little bit about the considerations for investing in index funds. Now, as you're looking at an index fund, you want to consider some of the following factors. The long run performance. Now, it's important to track the long term performance of an index fund, ideally at least 5-10 years of performance. And usually, when you look at the prospectus, it shows you the year to year, year to date, year over year, 1 year, 3 years, 5 years, 10 years, and further out it go. You can see what the potential future returns might be. But remember, past performance is no indicator of totally guaranteed future returns. But it does give you an idea because each fund may track a different index or do better than another fund. And some indexes do better than others over time. So the long play, like me and Dote always talk about, the long run performance is your best gauge to what you might expect in the future. Like I said, it's no guarantee either.
Yeah, but always take a good look at the expense ratio. If it's high and it's not performing better than say the S&P, it makes little sense to be invested in that particular index fund. So, you can look and see what they're paying. You can look at their long-term performance. And if it's performing well, you might want to pay a little higher expense ratio. But typically, again, nobody beats the market. So make sure you pay a reasonable expense ratio.
And usually the rule of thumb for expense ratios is it stays below 1.0 as expense ratio, because if it's 0.06, that's saying $6 for every $10,000 investing that you have. So, and I think we might talk about that. So I might be getting ahead of myself. But trading costs. A lot of people don't talk about trading costs. Some brokers offer very attractive prices when you buy mutual funds, even more so than the same mutual fund company itself. So that what that means, if you're going with an ETF, virtually all major online brokers now allow you to trade without a commission. A lot of times for mutual funds, they charge you commission for trading. Also, if you're buying a mutual fund, beware of sales loads. Sales loads are what they call front end load, back end load, meaning they charge you a fee on the front end when you first buy it, or it could be a back end load. When you go to cash it out, they'll charge you a fee to cash it out. And then some of them have commissions, which can easily chop off about 1 to 2% of your money before it's invested. And remember, you want as much as your money working for you as you can. So you got to watch out for all these fees and sales loads and commissions that some of these brokers try to charge you. Now they're easy to avoid by choosing funds carefully, such as those from many other companies like the Vanguard, the Fidelities, which is usually good funds, just to name a few.
Yeah, and when we say brokers, we're talking about brokerage firms. Bob mentioned Vanguard, Fidelity, Schwab, E-Trade, and there's probably hundreds of others. But those are typically the lower cost mutual funds. And as Bob mentioned, be very careful of paying loads, which is just a commission fee for their expertise. And there's hard data that says they don't beat the market. So you need to think about whether or not you want to pay a fee. And so all brokers don't offer all mutual funds. But if you look at the one we've talked about, most of them are going to have all of the mutual funds, a zillion options. Okay. So you need to see if your brokerage firm has a specific fund family, if that's what you're looking for, or if they have the particular type fund that you want. In contrast, ETFs are typically available to all brokerage firms because they are all traded on one of the exchanges.
Because there's over 6,000 mutual funds out there, though. So it's
Right.
not like you don't have no options. But another thing to consider when you're looking at index funds is the convenience. It may be a lot easier to go with a mutual fund that your broker offers on a particular platform rather than to open a new brokerage account. So going with an ETF instead of a mutual fund may allow you to sidestep some of those issues of paying commissions and all those sales load fees.
Right. Now, there are some risk involved. So putting money into any market-based investment, such as stocks or bonds, means that you could lose it all if the company or government issuing the security runs into severe trouble. Situation is a bit different for index funds because they're often so diversified. So we talked about before how that lowers your risk by being invested in a bunch of different funds. And typically it's I don't want to say impossible. It'd be very, very hard for every company to go under. And so an index fund usually owns at least dozens of securities, and they may own hundreds of securities, meaning it's highly diversified. Okay, in a stock index fund, for example, every stock would have to go to zero for the index fund, and thus the investor to lose everything. So chances are that it probably won't happen. So while it's possible, it doesn't happen for these types of funds. That said, an index fund could underperform and lose money for years, depending on what's it invested in. But the odds that an index fund loses everything, very, very low.
So there are fees associated with index funds. Like we said, mutual funds, index funds sponsored by a mutual fund company may charge two kinds of fees. I talked about sales load and expense ratio. Sales load is just a commission for buying the fund, and it may happen when you buy or when you sell, like I said, a front end load, or they call it a back end load, or over time. Investors can usually avoid these by going with an investor-friendly fund, such as the several companies that Doug talked about earlier, the Vanguard, the Fidelity, the T. Rowe Price, the Schwabs. There's a lot that out there. Now, an expense ratio is an ongoing fee paid to the company based on the assets you have in the fund. Typically, they are charged daily and come out the account seamlessly. So it's usually charged, you see expense ratio of say 0.05, that's $5 for every $10,000 you have invested a year. One other one I want to talk about is another fee that's called the 12B1. And that's the fee they're charging for all the marketing. A lot of people usually don't see that fee, but you can look at the prospectus and see how much they're charging for that also, which is called the 12B1. And it's for marketing and advertising that they spend on that. They pass that cost over to you. So if it's high, you might want to, compare that with the other funds, because for each fund it's different. And once again, that's money that could be taken out of what you're investing that could be compounding for you. That's why you need to pay attention.
Yeah, ETFs and some index funds are sponsored by ETF companies. They also have mutual funds too. And they charge only one kind of fee, and that's in the expense ratio. So there's no loads, there's no front load, back load. That's the only thing all their expenses are wrapped up in the expense ratio. That's why it's very important for you to study that and make sure it's reasonable. And it works the same way as it does with mutual funds, with a tiny portion seamlessly deducted every day you hold the fund. And so ETFs have become more popular, and because they help investors avoid some of the fees associated with mutual funds. And also, we talked about the tax advantage that they have over mutual funds. So ETFs are becoming very, very popular.
So I talked about the expense ratio. So what is considered a good expense ratio? I want to discuss that a little bit more in detail, because that is an important cost that can hinder the growth of your fund if it's a high expense ratio. So mutual funds and ETFs have among the cheapest average expense ratios, and the figure also depends on whether they're invested in bonds or stocks. So in 2021, the average stock index mutual fund charged 0.0% on an asset weighted basis. That means they were charging. Remember, I told you if it stays below 1.0, and that's 0.06, that means that it's $6. They charge you $6 for every $10,000 invested. That is very low, because actively managed funds definitely charge way more than that. The average stock index ETF charge 0.16, and that's $16 for every $10,000 invested. So that's how you look at the expense ratios, Ron, and not just on index funds, but on mutual funds. That's important, how you be able to tell how much they're charging and taking out of your potential earnings. Index funds tend to be much cheaper than the average funds too, by the way. Compared to the number above, with the average stock market fund, it charges 0.47%, 0.47%. That's $47 for every $10,000 you invested. So you can see how just a little bit more, not a little bit more, but just in dollars, what's that? Maybe that's about $31 dollars more than the average ETF that is charges 0.16%. So those are things you need to look at, you all, because that's the things can affect how well your particular index fund will grow. While the ETF's expense ratio is the same in each case, the cost for mutual funds generally is higher. That's why I wanted to point out about expense ratio. Now, many mutual funds are not index funds. Remember that. And they charge high fees to pay the high expenses of their investment management teams. Like we said, they are actively managed by portfolio managers, and they charge you for it. So anything below the average should be considered a good expense ratio. Like I said, the average was $16 per $10,000. Now, the perspective, and realize that the difference between expense ratio of 0.10%, and 0.05% is just $5 a year for every 10,000 invested. But still, there's no reason to pay more for an index fund tracking the same index. So look at that expense ratio. That can make a difference.
So you can ask, is this a good time to buy an index fund? Anytime's a good time to buy an index fund. If you're buying a stock index fund or almost any broadly diversified stock fund, such as the NASDAQ 100, for example, it could be a good time to buy. But the key is you want to hold it. You want to buy something that you plan on holding for a long time, not something that you buy, sell, or the market. Something you buy and you plan on holding it for term. You plan on continuing to invest in it because, as we've always said, it will rise over time. And as the economy grows, corporate profits increase. And in that regard, time is always your best friend because you get compounding. And we've talked about the value of compounding. It lets your money make more money. So nearly diversified index funds, if for example, a fund focused on only one industry, it might do poorly for years, but you might know that going in. And again, it's a 5 or 10-year play. But that's why it's crucial for investors to stick with a patient approach when it comes to picking an index fund or mutual fund, and you have to be able to ride out any short-term volatility. You don't want to buy and sell. And so you also want to continue to invest. We've talked about dollar cost averaging. That means you put a set amount in each month, and if the market's going up, you're buying fewer shares. If the market's going down, you're buying more shares. You're buying more when the market's low. You're buying less when the market's high. I mean, that's the way to do it, as opposed to panic selling and buying more when the market's going up and selling when the market's going down. So a strong investing discipline can help you make money in the market over the long term. Stop trying to time the market. You're not good at it. And that's jumping in and jumping out. And it doesn't work. And the other thing we didn't mention, and I want to make sure you understand, let's just say you want to buy the S&P index fund, okay? And if we were to put a percentage on the market risk, that would be 100% if you put all your money into the S&P index fund. But let's just say, and we've talked about this before, my risk tolerance is about a 70%. So I'm looking to be, I want 70% of the total risk in the market. So if I was to buy an index fund, I would put 70% of my holdings in an index fund, and I'd put 30% into something like CDs or TIPS or savings accounts, something that's 100% guaranteed, but pays a lower risk. So my return is going to be the average of that 7% in the 70% in the market and the 30% in fixed instruments that are very conservative and pay a lower rate, low risk. But I'm willing to accept that because I don't want to accept 100% of market risk. So again, that's why I wanted to make sure you understand there's a risk. There's always a risk element when it comes to investing. You have to determine what your risk tolerance is. Okay. And it may be different for different buckets of money. For example, the money you have to put away for junior's college, that's money you should probably be conservative with. If you need money for a down payment on a house, that's money you should probably be conservative with. But if it's money that you want to invest for the long term, that's money you might want to accept a little more risk in. So again, I would never, I'm not giving advice, but I would never myself put all of my money into the stock market. But again, so I'm not willing to accept 100% of the risk in any situation. You have to determine what level of risk works for you. And that's just want to make sure we're clear on that.
Thus, ladies and gentlemen, you now have been exposed to the contrasts between Thomas Doty and Bobby P. Kinser. Thomas does 70% in the market, 30% low risk fixed. Bobby Kinser does 70% in the low risk and 30% in the market. And that's why we do this show, because we complement each other. I don't want to take that big a risk because, well, I can go into, some of the reasons why, because, we got big money bags over there. But, but no,
You you got years of college yet to come, so I don't have that.
and that's what makes the difference, though. So look, so the bottom line, though, to all of this, you all, is there are a lot of good index funds out there on the market and offering investors a way to own a broad collection of stocks at a low cost while still enjoying the benefits of diversification and low risk. With these benefits, it's no surprise that there are some of that index funds are some of the largest funds in the market. So, why did me and Dope decide to talk about index funds today? And it's because I told you last week, a lot of people on here who are retired, they think that it's too late for them to be investing, and it is not. And so people are always asking us for stock tips. We don't give particularly specific products to buy, but index fund is providing you with an investment option, an investment vehicle that you can use to help you build wealth. Like I said, if you're cool and retired with what you got in your retirement fund, well, that's cool too. But if you want to build some generational wealth so you can leave, this is one of the particular alternatives that you can get into. And that's why we decided to talk about index funds, because you don't have to do, it's just, we're going to do a recap on why we talked about all the index funds and why it's important. Just remember, though, it's just one particular investment option that you can do. And there's several other ones, but we always talk about being in the market. And people ask me, why are you doing all for the market? Because we showed the last 2 weeks with the 1%, the majority of all their earnings come from being in the market. So with that, Dope, no further ado, I'm going straight to the takeaways, because these takeaways in summary today is going to sum up why it's so important to consider index funds.
Okay, and the first one is diversified. Diversification is always important, which yields low risk. The more diversified you are, the less opportunity you have for a huge drop in value of your investments. So that's one thing they provide. They lower your risk by offering you a diversified product.
Ease of investment. You can buy them anywhere. They're easy to buy. There's lots of options, like I talked about. And it's just so much more of an ease of an investment, because you don't have to worry about, having the expertise to have doing the research and things like that.
Low expenses. We talked about mutual fund loads and front loads and exit loads and other fees and cost to buy stocks. Very low expenses with index funds.
It's minimum oversight required. What does that mean? You don't have to worry about rebalancing, buying and selling, analyzing a bunch of stocks for the portfolio, and it's a low portfolio turnover. So it's definitely minimum oversight, as opposed to, you having individual stocks and companies that you got to continue to watch and research and do technical analysis and fundamental analysis. No, that's why we're recommending index funds.
And there no technical expertise required. And in the simplest form, you could say, I want to invest in the S&P index fund. I want to make whatever the market does. That's what I want to do. You don't have to analyze stocks. You don't have to, as Bob said, rebalance. And you don't need to be a technical genius in order to pick an index fund, especially if it's broad based. And that gets you out of the analytical area of picking individual stocks.
Hey, Dope, how you like my little graphic there with the bull and the bear, man?
You know what they say: bulls make money, bears make money, pigs don't make nothing. So
That's
don't
not
be.
what they say. They say pigs don't make
I'm not going to be cussing.
crap. No, I'm not going. I'm not going to cuss crap. But wait a minute. Don't say it again. Bulls make money.
Bulls make money, bears make money, but pigs don't make shit.
I guess you just put it straight. I can't think you can be no straighter than that.
And what that says is anybody who invests, whether you're a bull or a bear, you're probably going to make money. That's just how the stock market worked. It always has. It's averaged, as we said, 10%, somewhere between 9 and 11% over the last, 80 years. So it's going to make money. But you just can't be greedy, and you have to have a plan. And we we don't want to make you think that you cannot ever do any analysis. You'll have to decide which index fund you pick. So that's going to take some effort on your part. But once you pick it, if I'm assuming you make a sound choice, you can pretty much just not have to worry about it as much as you would a regular portfolio, where you have to follow individual stock, you have to follow the industry that stock is in, you have to follow the country that stock operates in, all the economic situations. There's just so many more things to consider when you talk about buying an individual stock versus buying an index fund. I'm hoping that's one of the reasons that a lot of people don't invest, because they feel they need a lot of technical expertise to do it. But index fund takes that excuse away, because you can do that without having to do a whole lot of analysis. So we're trying to eliminate all barriers to investing, and hoping people can get into the market and take advantage of the money that's been made, and is to be made. And that's not to say, again, it's always going to go up, but over the long haul, it always has gone up. So there's reason to believe it will continue to go up.
And Dope, the guy you said, Jack Bogle, who was the guy who was the CEO and created Vanguard, he
Mhm.
said before he died, he said he was telling people, investors, he said, just and I'm not recommending this, I'm just saying, quoting him what he said. He said, the best thing you can do is take your money and put it in a mutual fund or index fund and just leave it there and don't look at it again for 10, 15 years. That was what he said, Bogle. And I'm not recommending that, but I'm just telling you all the how these mutual funds and these index funds work. It's no guarantee, but he said that. He said just leave it and don't even look at it again. That's the power. And so once again, you all, we thank you for tuning in, and I hope you understand why we're talking about index funds.
Let me just make one more point. And see, we always talk about, if you need help, get help. But when you buy this mutual fund or index fund,
Boom.
you're paying for that help. Somebody's providing the expertise for you. So it's a lot easier for you to put the money in there and then maybe forget about it, because it is being managed, as opposed to trying to buy individual stocks, in which case you have to constantly be on top of what you're doing. So in the case of mutual funds, index funds, you're paying for expertise, okay? But you're doing it in a broad-based environment, which keeps your cost much lower than it would be if you tried to diversify that fully on your own.
And the other main one, though, trying to time the market. That's why it says in our speaking earlier that fund managers, the market usually outperforms fund managers. That's meaning that they can't even time the market, because that's what they're trying to do. They try to time the market. That's what fund managers do. So we hope that was helpful, you all. Thank you for sticking with us again for another day. This was show 113, head to 114. If you have any questions, please put them in the comment box or any statements. Want to, as we always do, shout out to our wonderful audience. Garnett, thank you for hanging in there. My brother Carl, what's up, bro? Thank you. Carl said, good show, brothers. My sister, I love you so deaf. Love you to death, Linda. My mother too said, hey, Noli's there. My father may say, where's Noli? Hey, Noli, how you doing? Thank you for staying. Noli, you're a stalwart, girl. Thanks for hanging in there with us. And Garnett, thank you so much. So look, that's it for us today, you all. Another fun, full packed show of information. Tune in next week, Thursday, 8 p.m. Eastern Standard Time for the FITT Show. Financial information for today and tomorrow. Take it easy, dope.
Peace, my brother.
Peace.